So my name is Benjamin Joseph, and this would be my video presentation for the answers I've written for the midterm exam. So the first question is, discuss whether asset allocation has changed with respect to the UN's SDGs that they set out. So personally for me, I feel that asset allocation has changed with respect to the SDGs that were put out by the UN. 5 reasons as to why SDGs affect asset allocations would be because SDGs provide insights to an investor about the sustainable directions relevant to their current investments that they have put out. The second reason is because investors are considered to be universal owners. They are a part of the global capital markets. Hence, their investments are based and would get affected based on the overall economy. So failure in adopting SDGs for these investors would lead to a long-term risk for them and the overall economy, as they don't adopt SDGs. The third one would be SDGs are considered to be a driving factor for the economic growth, as the investors seek economic growth, so they have to adopt the sustainable development goals to gain the economic growth. The fourth one would be that SDGs is considered to be an external expenditure. So this means is basically if they have any environmental sufferings that they perform or any social disruptions, this affects their capital, their company's capital. And the fifth point would be that SDGs provide a capital allocation guide for these investors, and they also encourage to adopt sustainable practices in their companies, and they also provide investors with solutions as to how to deal with their sustainability problems to increase their attractiveness in their opportunities. Okay, so the second question was, using 4 stocks, explain the portfolio management processes used to determine whether to invest in a sustainable or non-sustainable company. So how I analyze is that I've calculated the COVs, the coefficient of variances for the 4 companies that were the 2 companies that were sustainable and the 2 companies that were unsustainable. And to measure COV, the formula is standard deviation divided by mean, and COV is often used to calculate the volatility of the return. So I taken the 4 companies from the UN Sustainable Report, and the 2 companies I taken that were sustainable were Panasonic and Coca-Cola, and the unsustainable companies that I taken were Starbucks and AT&T. Moving on, using investing.com, I'd collected the historical data for these 4 companies for the 2 years, 2017-2019. Using this, I derived the closing prices on a daily basis for these companies, and using these prices I was able to calculate the LV returns, and the LV returns I'd use by taking the down price divided by the up price to gain these amounts. And moving on, to calculate the mean, I had used the average of the LN returns that were here, and the standard deviation, I'd done the code that was standard deviation and did the average of the LN returns. And to calculate COV, finally I had done standard deviation divided by the mean to gain the COV amount. So this method was followed for all the 4 companies using Excel, and using these amounts I was able to calculate, I was able to analyze and see which one would be right for the investor to invest in. So therefore, if I was an investor considering like the most risk averse stock, I would personally go towards the unsustainable stock in AT&T, as it provides the least volatility but like a decent amount of return. Whereas if he was if I was looking for a sustainable stock to invest in, I should invest in Coca-Cola, as it's less volatile in -1.28, giving me like a less risk. Although if what I would do, I would diversify my portfolio by investing in both sustainable and the unsustainable stock. So the third question I'd be talking about is advise a client as to how to select 5 sustainable investment strategies. So the first one I'm going to be talking about is social impact bonds, SIB. So this would be a good sustainable investment, as investors would not only have to focus on their financial returns, but they also have to focus on the social impact of their investment as well. Moving on to the next one, that's green suhooks. So green suhooks would be a good investment for the investors, as they're solely based on renewable energy and other environmental assets. Some eligible assets for these investors would be electric cars and solar parks. The third one I'm going to talk about is ESG indicators. So ESG indicators would be a good investment for the investors, as they wouldn't only have to monitor their company based on their investments, but also on their ESG factors. ESG being environmental, social, and governance factors. And if they fail to comply with these ESG factors, it would inversely affect the rate of return of the investment. Moving on to carbon pricing. So carbon pricing would be a good investment for long-term investors, as investors can now reevaluate and make their investment planning based on low carbon and climate resilient activities, which would provide them a more sustainable portfolio for the future. And the last one being REIT, sustainability. So real estate investment trust creates a demand for investors seeking sustainable investment strategy solutions to their already existing portfolios of real estate assets. So the fourth question I'll be talking about is discuss whether capital market theory can be extended to include digital currencies. And so to begin with, cryptocurrency or virtual currency is an expanding platform for payment in the recent years. Comparing cryptocurrency to traditional currencies such as the dollar and euro, traditional currencies are highly dependent on the global economic conditions, whereas cryptocurrency is based on the demand and supply, and the prices are basically made for cryptocurrency based on these factors. So to answer this question in depth, I use an example of an investor that's developed an interest in adopting cryptocurrency into his portfolio. In the beginning, the investor was skeptical, as he did not know how cryptocurrency would fare in comparison to his other portfolios that he currently had. The 4 portfolios that he had were forex and commodities, general stocks, exchange trade funds, and mixed assets. So when he had compared these 4 portfolios with cryptocurrency, he had realized that he had generated a greater return in comparison to his already existing portfolios with the addition of cryptocurrency. Moreover, with the help of this analysis, the investor was able to analyze that adding cryptocurrency onto his existing portfolios, it generated a greater return for him, and that he would bear a lesser risk and gain a greater return. So these are the 4 questions that I have answered for my midterm. Thank you.